Hello everyone, welcome to this trade management mini session. My name is Barbara Armstrong. I'm a coach with Charles Schwab and delighted that you have decided to tune in to this mini session. What are we talking about today? Great question. We placed 3 trades on one stock, and we're going to go back and look at those 3 trades and have a conversation and compare a long put vertical, and a short call vertical, all of which are bearish strategies. And we're going to do that in, somewhere in the neighborhood of 10 minutes. So buckle up. I invite you to follow me in the land of X, my handle at BarbArmstrongCS. I hope that you'll join me there. These are all option strategies, so it is important to keep in mind that options carry a high level of risk and aren't suitable for all investors. You have to apply for option trading privileges with Schwab, and not all will qualify. We've got to take commissions into account. We also use the paper money software application on the thinkorswim desktop platform. It's a brilliant place to learn. Become familiar with the platform, become familiar with these trading strategies before you attempt them in your live account, if you choose to do that. One of the differences is that short positions will never be assigned early in paper money. That can happen in a live account. And so we don't get to practice that, but we do get to discuss it. Okay, so let's get right out to the platform. And let me just bring that up. So here is our chart on Dollar Tree. And what I want to point out is that I put a green circle around where we entered the trade. And so we did a short call vertical, and we placed that trade on the 29th, and it hit our target, and we ended out of that, I believe, on the 2nd. We were reviewing that trade on the 5th, and we said, hey, looks like Dollar Tree is still falling. And so we placed 2 new trades, a short call vertical and a long put vertical, and we ended up hitting our targets on both of those on the 12th. So how did that pan out? Let's go and look at the numbers. So to look at the numbers, where do we go? We're going to come to the Monitor tab, and we're going to come over to the account statement, and then I typed in Dollar Tree, and we're going back about 3 weeks in time. And so let's look at these 3 different strategies. So the first strategy was our short call vertical. And so when did we place that trade? Well, we placed that, like I said, on the 29th. And we did 3 contracts to open this trade. This is our call vertical here. And we were paid 53 cents when we got in. This trade closed out on August 2nd. So we weren't in it very long, which is, it's typical for us to be in perhaps a little longer, but, this wasn't. Sorry, my drawing tool decided to take a little break there. So we got in for 53 cents and we got out for 8 cents. Okay, and so what did we end up making? Well, not taking commissions into account, and for this exercise, we're just going to kind of keep it simple. We ended up making $45 a contract, and we did 3 contracts. And so our net gain was $135. And, this is an account that started back in November with $20,000. So $135, that has us smiling, and we're happy with that. And so this is our short call vertical trade. Now, how much were we risking? Well, we had a $2 wide spread. So if we're looking at our return on risk, we made 45 cents per share, and we were risking $2 minus 53 cents, or $1.47. And so our return on risk on this one was 30.6%. And we were pretty happy with that, especially for a short call vertical. Often that number might be, kind of in the 18 to 25% range. So a 30% return on our short vertical is a nice return. So we're happy campers, base hit. Now, what about the second trade that we placed on the 5th. And we did a second trade and a third trade. So if we look at our second vertical trade, we did a long put vertical. And we had a very narrow strike width. So it was only $1 wide. So we can see that it was $1 wide. We paid 50 cents to get in. And so if we can risk $500, how many contracts could we do? Well, we could do 10, and that would have us risking $500. We got out of this on the 12th, and that was for 75 cents. And so, you know, if you do a lot of these, so if we put our long put vertical over here, and we do our math, so we got out for 75 cents. We got in for 50 cents. And we were risking 50 cents. And so our net gain was 25 cents a share. And then, you know, or $25 a contract, and we had 10 contracts. And so we ended up by $250. And so, you know, from a dollar perspective, you know, this one was $1.35. We were happy with that. So we're definitely, you might call that a double. You know, we were happy with that. And what's our return on risk? Well, what we were risking, a little easier to calculate here, we're risking the entire amount we paid when we got into the trade. So 50 cents a share. And how much did we make? We made 25 cents a share. And so that was a 50% return on risk. Spot on. Does it always work out that exactly? No, but that was our goal, and we achieved it. And so, you know, we were, you know, happy with that as well. Now, as it turned out, the direction, we were correct on direction on this. Otherwise, we could have been discussing 3 trades that didn't work out. And that sometimes happens. And we've had that happen actually several times in this account this year. You know, so not everything always goes according to plan. And this is why position sizing is so important. But trade number 3, we just flat out bought a put at the same time so we could compare them. And this one, we couldn't do 10 contracts like we did here. We only did 1. Why is that? Because our position sizing rules say we don't want to risk more than $500 on any one trade, and we paid $410 to get into this one. And so, and how much could we have lost? All $410. Now, this one hit our target, and this was a 1 ATR target, and ATR being the average true range. So it was a short-term target based on the amount that Dollar Tree had moved in the last 14 days in an average day. And so it hit that target, and we closed it out on the 12th, and we were closing that one out. So we sold it for $4.90. So if we come back and we do the math on this one, and this is our long put, so door number 3. Our long put, we sold it for $4.90 a share. We paid $4.10 to get in, so we were risking 80 cents. Or sorry, we made 80 cents. I misspoke there. So we made 80 cents a share, or we made $80 on that, less the transaction fee. And it's 65 cents to place that option trade, 65 cents to close it out. So when we look at that, that was $80 was our net gain because we multiplied that by 1. And again, maybe we call that a bunt. I don't know, a light base hit. Maybe this is a single, a double, a triple. But we made $80 on that. And what were we risking to make that $80? Well, we were risking $410 because that's what we could have lost. So our return on risk on this one was lower. And does it always work out this way? It does not, but 19.5%. But when we look at these, which is the most directional? That would be the long put, is the most directional trade, because it has to move, and it has to move within a certain time frame, or time decay really starts chipping away. Which one is the least directional is the short call vertical, because if we have our strikes here, as long as it stays below those strikes, it can go sideways and we're fine. Now, which one is, in the middle? Well, that would be the long put vertical. And the way we structure it, typically we have the first strike. The strike we bought is usually at the money or in the money, but it still has to go some distance and then stay below the sold strike for us to get our max gain. And so directional, least directional, most directional. And again, depending on how you place the trade, which one has the highest probability of success? Well, some might argue that depending on where you place your strikes, it's the short call vertical, because it's bearish, but bearish to neutral. So again, if it goes sideways and you've already placed your strikes above where it's currently trading, if it just stays where it is, you're okay. Where with the long put and long put vertical, it generally has to travel in a downward direction and stay there, or at least stay there temporarily until you meet your target for it to be successful. And so even though, when we look at it, which one, made the most, it was the long put vertical. And this is not uncommon. That color doesn't show up very well. Uncommon for us to see this. But you trade that off with which one has the highest probability of success. One might argue that might be the short call vertical, which is less directional and returned less. And we also risked more to get this return, because we were risking $1.47 for the chance to make 53. Here we were risking 50 to make potentially 50. So we were risking 50 to ultimately make 25 was our goal. So these are all things that we have to take into consideration when we're placing these trades. I hope you have found this conversation helpful. Again, these were example trades for example and educational purposes only. Thank you for joining me, and stay tuned for another mini session coming your way very soon. Bye for now.